Good evening, everyone, and welcome to this lecture. To start with, we've got about 7 to 8 new members, and I would appreciate that this was a suggestion from you that each one of you just get up and introduce yourself and what made you get into this FOF movement. Please. How many are there? How many you are starting from there? Okay, so let's start from there. Please.
Good evening, friends. My name is Arvind Medekar. I am from Rotary Club of Thane North. What made me here? It's only Parag. Thank you.
My name is Milind Nagre. I am also from Rotary Club of Thane North, and I was looking for the investment options. What should we do in the future? So I thought this is a good forum to be taking for.
Hello, I am Tushar Khatira, and I come here to learn.
Hello sir, my name is Hardik Jain. My friend Kunal had attended the session last time, so he told me that it's quite interesting. So I thought I'd try it.
My name is Saral Bansali, and I am a big Buffett follower, and when I saw some of the videos online, they were clearly kind of linked with my investment philosophy. So I thought it's a good chance to learn from you.
Hello friends, my name is Umang Shah. So we have been following your videos and just wanted to take this as a learning opportunity. So
I am Abhishek Jain. Same with me, I've been following those videos, I've come for some more learning.
Thank you. Anybody else? No.
Sir,
sorry.
Sanjay Randhire. Last 10 years back, you recommended UTI Bank at 28 rupees. Today it is 1,400 rupees. I am your follower from that particular 10 years. And he told me to sold Visual Software at 10,000 rupees, which I didn't sell, and now the price is only 26 rupees.
Thank you very much. Well, just to take it up from there, when we started the Financial Opportunities Forum, it was in our Rotary Club, and our past president Mohan Lalwani was the one who initiated it. Normally all Rotary clubs always have investment clubs, and they only start in a bull run because that time everyone wants to invest into stocks. So always investment clubs are a product of a bull run. We over here, we started in 2008-9 when the markets were totally down and out. And my first letter which I wrote to all the members of our own Rotary, that is Bombay Midtown, was that this is not for giving tips, this is for learning financial literacy, because financial literacy is very important. Stock markets, nobody can understand what's going to go up or down. But after following Warren Buffett for over such a long period of time, we thought that having a movement where we really discuss Warren Buffett philosophy, which is long-term investing. But all of us would have read books on Warren Buffett philosophy and all, but it's very difficult to put into practice. Why is it difficult? It's because whenever you are in a market, people would always like to talk about their successes. They would never talk about their failures. So in a market, when you ask anybody what happened, oh, I made money over here, I made money over here. And then you feel that you are the only fool who have not made any money in the markets. It is not that they are smarter than you. They all are the same. But the problem is, nobody speaks of the truth. So in order to be really into long-term value investing, what we really require is a movement or a community of value investors. Because it's when the markets are just going up and up and you are not able to decide what to do. You get trapped into stocks like Visual Soft and all, Visual Soft was a stock which he mentioned was at 30 rupees and it went up all the way to 10,000 rupees. 10,000 rupees it would be quoting at somewhere around, I'll tell you, 2000 P. It was absolutely expensive. But as an individual, if you have to make a choice that time, you will feel whether I am right or the market is right, or am I wrong and the market knows everything. But when you have a community of right-minded people, then we are able to share our ideas. And I think that is what gives us the strength to be really contrarian and be away from the maddening crowds. I'm sure now our next meeting would be in the month of May. We will try to keep it this thing after the elections, or I would say after my colleague Rajiv and Neil. They both are going to Berkshire Hathaway meet this thing at Omaha, and I'm sure they will come out with really good insights. So for the next 2-3 sessions, we'll definitely have their take back from the Berkshire Hathaway meetings.
What date are they going?
They are going, Rajiv is going day after tomorrow, Neil is going 20th. They would be coming back around 17th, 18th. Yeah, 17th, 18th of May. So we'll have it somewhere around there.
Last time also they had.
Yeah, last time we had the same. And now this time both are going, so they will be coming with more insights, and we'll have at least 2-3 sessions trying to get a glimpse of what's exactly happening over there. With technology, I hope they are able to get some videos or something like that. Let's see. It's not enough. Okay, no. Okay. Anyway, the markets today, the way they are going, it's anybody's guess whether BJP will come to power or BJP may not get the right majority. But I think it's pointless discussing any of those things because nobody knows about it. If I ask a speaker to come over here, it would be his views and it would be his guesswork. Any of us could be having a guesswork. So anyway, today what we are, Neil is going to present today an interesting subject about timing the market or timing the market. It's very appropriate at this stage because people are feeling that if they don't buy the stocks today, what if BJP comes to power, the stocks will have a run. So people are trying to time the markets today. Now let's see from Neil whether is it the right thing to do or we can think of certain other things. Please Neil, thank you.
So these days we see that investing is happening in a bit of a haphazard way, people invest by listening to tips that they hear at parties or in a train and they work on those tips, or they work on, they buy some stocks because they've heard some so-called market expert on CNBC or NDTV saying something about stocks. They don't do their homework. Other people, they bet on certain events, like you just mentioned. Last few months we've had a lot of people coming and saying that we expect some negative surprise in the elections, so we'll wait for the elections. And this is about 4-5 months back, and we've seen what all has happened in the last 1 month, how the markets moved up. Other people, they bet on certain macros. For example, 2 years back, when the rupee was depreciating against the dollar, we had people saying that I'll wait till the rupee touches 70 and then I'll invest. Well, those days they never came, and I doubt it's going to happen in the near future. So a lot of these people, what they try to do is they try to catch the bottom, and they also try to catch the top, which is extremely hard, almost impossible. So this thinking makes people enter and exit the market at all the wrong time. And why is this? Why does this happen? Is because of over-information. We spoke last time about availability bias. Like when you are just burdened with so much information, and it's usually all noise. It's usually all noise and very little. And that's why people get so enamored by this and take all the wrong decisions at all the wrong times. Also, when you can see the market every day, like you can see every day what the Sensex, Nifty movements are. So you start thinking in a very short-term kind of a way, and this takes your balance of this actually makes you doesn't make you have your greed and fear in check. You know, you start doing stuff which is against those. So what happens is that when we talk about equities have done well and equity investors haven't done well, you know, it is mainly for this reason, you know, because of this reason of entering and exiting at all the wrong times, and also not keeping the greed and fear in check. This is why people lose money, but equity as an asset class has actually done well. So basically for long-term wealth creation, a process has to be followed. Discipline, patience, and a fundamentally sound philosophy has to be followed. For us, that's the only way in which we can make money in the markets. So what do we mean by time in the market? Time in the market is you should be investing for the long term. As we go on this presentation, we'll be probably define what this long term for us means. There's an accepted fact that equities achieve higher returns over the long term. Okay, we are not talking here about a short term or something. Over the long term, that we said we will define those what that long term is. But recently, and by recently I mean in the not last 1 month, 2 months, but in the last 4 years. Last 4 years, we've seen market volatility and poor equity performance. You know. And frustrated equity investors are shunning equity investment. So we've seen this a lot in the last few years, in the last 2 or 3 years, that a lot of people got frustrated with the markets. They didn't make money for a year, 2 years, market didn't move at all. And they said, and in the last 6 months to 1 year, we saw a lot of exits from the market. And now today, for those same people, it'll be very hard for them to enter the market because they've exited at the wrong point, and now as the markets have gone up, it's very hard for them to invest back in when they've seen such a lower market. So these are the kind of things that has been happening in the last 3 or 4 years. So we need to be careful about it. So let's go ahead. This is the performance of some of the equity indices over 1, 2, 3, 4, 5 years. You know. Obviously, like I said, the last 4 years has been a little frustrating. Its market hasn't still moved. Also, let's take this 1 year returns with a little bit of a pinch of salt. I actually gave this presentation last month in Hyderabad. It was actually March 5th, and the returns actually look way different than what it is today. For example, the 1 year returns were only about 9%. In 1 month's time, you've seen what can happen there. 2 year returns was about 7.5%, 8%. Again, you know, in the last 1 month, these are the returns. And when you look at it in a longer term, about 5 years, equities have done pretty decently, you know. And these are just the indices we are taking. We're not. It's not an actively managed fund or a portfolio. So those could even achieve higher returns than this. So because of this, investors are asking the following questions: how long is that long term? Whether long-term investing theory is all wrong, whether the decision to invest in equity as an asset class was correct. So we try to answer these questions as we go forward. So how long is that long term? It depends. It depends on who you ask. If you ask an investor, he'll say it's from 3 years to 10 years. But if you go to a trader or a speculator, he'll say 10 AM to 3 PM. So it actually depends who you're going to ask. So there's a correlation in the market about holding period with the returns that you get in the market. Holding period is just the average time period that you hold a stock. Today, with a click of a button, we can buy and sell pretty much anything we want. You know, with the internet age, everything is with the press of a button. We also live in this age of instant gratification where it's very hard for us. We want everything right now. These are the 2 factors which is affecting the holding period of the investment. So as this holding period comes down, the returns are also going to be affected in that way. Okay, so I'm just going to give you a trivia. Do you know, anyone knows what can actually just guess what is the average holding period in the US for a stock? Just guess.
6 to 7 months.
5 years.
22 seconds. 22 seconds. So you see, when the investment, the average period of the investments coming down, it's very hard to actually fathom in 22 seconds how how much you can make, what returns are you going to get. So we've seen this in the last few years, since the internet age or even slightly before that, that the holding periods have been consistently coming down, which have been affecting the returns. So how long is that long term? So for us, the long term is at least 5 years. If you want to invest in the equity market, at least have a 5-year view. If you have some expenses which are going to be there in the next 1 year, 2 years, 3 years, or even 4 years, then better that money is not put into the equity markets. You probably put in a liquid fund or something which is more liquid where you can get the money. As we've seen that the last 4 years, we've seen periods of 3 or 4 years of non-performance. So if you really require that money, say if it's of your children's education or the wedding, or if you want to buy a property in the next 2 or 3 years, equity markets is probably not the way you should put your money there and try to see if it grows, because it can go the other way around too. Because patience is required in the equity markets, and if you have short-term needs, then I don't think you should put it. So for us, we'll define this long-term as at least 5 years. So let's see whether long-term investing theory is all wrong. So here I've not taken a point-to-point return for a day and after 3 years what is the return. This is an SIP. An SIP was done, we've taken this as an SIP done every month for say 20 years, for 10 years, for 5 years, 3 years, 1 year. I think that gives us a better sense of what the returns are instead of just taking a day and seeing, okay, after 3 years what is the day, because it could be up or down that day, you never know. But this gives us a true the true value of what investments have returned. Obviously, again, take the 1 year with a pinch of salt. It's all in the last 1.5 months, so you can probably think of that as a bit of an outlier right now. But if you see over the long term, equities have definitely performed much better. You're getting more and more returns on an SIP. And also we need to remember that after 1 year, these are all tax-free returns. So equities are pretty much tax-free, there are tax-free assets, and also at the same time, the compounding effect works here. So when you compound when your returns are getting compounded, you can actually exponentially make that much money. For example, 1 gram of gold in 1980 was 100 rupees. The Sensex started in 1979-80 at index level of 100. Today the Sensex is at 23,000. Gold, 1 gram of gold today is at 3,000. So you see that equities have outperformed something like gold, which is supposed to be pretty safe and all that, by a factor of almost 8. And this is all because of the compounding effect that works in equities. So we need to realize that also, even if it's a 12%, 13% kind of returns you're getting, over the long term that's going to be compounded and you can exponentially make that money. So that is one. So
there's one question. Why 1 year you made 24% and then last year?
This is all last 1 month.
1 month now.
1 month basically, 1.5 months.
Modi effect. Modi effect.
So we're not talking about absurdly long periods of time here. 5 years, 10 years is not that long. As Indians, we invest in gold, real estate, insurance products, provident funds. And we don't monitor those like how we monitor our equity investments. Equity investments are meant for the long term. We look at it at in a very short term kind of a way. It's just because we can see the market every day. It's not like if you are owning a property, you don't go every day to your broker and say, hey, what's the value of the property today? You'll take that time. You'll value it every once in 6 months, once a year. And with equity, we should do the same thing. We shouldn't be looking at it at everyday time, on an everyday kind of a basis, because your long-term investments, you start looking at it on a very short-term horizon. So that's one of the mistakes we should not make. We should know that this is for the long term, at least 5 years. So let it be. It's okay if the market was 400 points down today or something like that. It's not a big deal. It's a small blip on the overall 5-year period. Investors have shorter investment horizons over which stocks may not earn a high return. This all has to do again with the holding period coming down. Again, as you can see the stock prices every day, and we're living in this world of instant gratification. So the investment horizons have been starting to come down. The people are holding equities for shorter and shorter time, which makes it even harder for for those investments to work. So we need to keep that in mind too, that at least for 5 years we should keep the investments. And also we spoke about this also before, that probably a stock return beating the risk-free the length of holding period. The longer you hold, the more you're going to make. So so these are the kind of conclusions we can get from the first two things. Let's take this example. I'm going to give this example because I just want to see how differently we think of equities compared to every other thing. So you have this scenario, you're going to Mumbai to Delhi, you're flying to Mumbai to Delhi. Expected travel time is about 2 hours. You book this ticket on yatra.com, you're flying Indigo Airlines. And actual time taken is 4 hours, and the cost for the delay was bad weather, fog in Delhi. So my question is, would you book again from yatra.com? Would you book a ticket again from yatra.com? You will, right? I mean, it's not yatra.com's fault, right? I mean, there's bad weather. And would you fly Indigo Airlines again?
Yes.
It's probably the best airlines right now, the best domestic airline. I don't think anyone would not fly that, you know. So you would do both. You would use the same service provider, and you would also fly Indigo Airlines again, you know, with this. Now, at the same vein, if we are investing in the equity market from 2008 to 2013, that's our investment horizon, 5 years. Where obviously with equity investment you expect at least 15 to 20% returns, but you get only 3% in a top rated mutual fund. Now cost of poor return was maybe global factors, subprime, any of those things, corruption in India, whatever it is. Would you again put your money in equities, and would you put it in that same mutual fund? No. More likely you wouldn't. So this is the problem, that we think of equities in a very different way than we think about a lot of other things. So we have a very shorter term approach to equity when we think about equities, because here the failure was not of the vehicle, and in life sometimes, you know, uncertainties come. There are times where it's unpredictable and some things happen, and but that's the beauty of life, that it is unpredictable. If it was predictable, you'd all be rewarded. So I think you should take that also in our stride, that sometimes bad things do happen, but there's always anything that goes down will eventually come up. Tides always change, so sometimes patience is just what's required. And this is the problem what happened in the last 4 years. I mean, we've seen a lot of people just exiting at really the wrong times. You know, they put in money 3 or 4 years back, but in 1 year or so many of them in 6 months, 8 months, they don't see their return. They'll take it away. You know, I mean, they take their money away, and when the market again goes up, it's very hard for them to get back into the market because they've seen those low positions and they felt like they missed the bus. So these are the mistakes we shouldn't be doing, and when we're thinking of equity, we should think of it like we think about everything else. You know, we can't take it in isolation, thinking of it in a short-term basis or something like that. So that's the thing. So here, so now we talk about some timing in the market. So the consensus opinion for what we've seen is always wrong, and by this what we mean is the herd mentality. When the herd mentality is extremely strong, usually it always goes the other way. Today, and I'll show you this with some data also, how that is, how this is like the consensus opinion is always wrong. So our investment theory says that buy low and sell high. You must have heard us say this all the time, be fearful when others are greedy, or buy when you don't feel like buying at all, buy equity when you actually don't feel like buying equity. Now why do we say that, you know? I mean, I'm gonna, can everyone see this?
Yeah.
So, these are some of the events that have happened in our history. On November 28, 2008, Lehman Brothers collapses. Market goes down from 19,000 to 9,000, about 9,000. Mutual fund sales at that time was only 2 crores. When the market went down, and this is around that same period, there was hardly any mutual fund sales. In fact, if you want to buy low and sell high, then this was a great time to do that, you know. But look how many people actually participated. 2 crores. I mean, only 2 crores that came into the market that day. June 30th, BJP election defeat. Market again falls sharply. I think we had a lower circuit that day. And at that point, 6 crores was actually taken from the market. After the World Trade blast, and this was a time when US wanted to invade Afghanistan, and also at the same time, the tech boom was becoming a bust. This is the time that was happening, and that time the market fell sharply. Again, 97 crores was taken from the market. Now, on the other end, during the tech boom, which was on Jan 31st, 2000, look how much money came into the markets, 1,604 crores. So people, and again on December 31st, 07, I think that's pretty recently, during the market peak, when market was about 20,000, about almost 3,700 crores was pumped into the market. And this is the reason, this is not timing the market, this is actually, I would like to call it mistiming the market, because every time it's always been mistiming, it's never been timing. As you see in here, you wanted to buy low and sell high, you've done exactly most of the people have done exactly the opposite of that. They've bought high and probably they've not been able to sell. And when there's a chance to buy at a lower price, a lot of people have been scared. So that's why we say be fearful when others are greedy, and greedy when others are fearful. And this is the reason why there's been poor returns of equity. Equity investors are not happy. They've been shunning equity investments because they've been entering and exiting at all the wrong times. And obviously because of this, they've come and gone at the wrong time. Equity ownership in India is extremely poor. I think the penetration rate is only about 3 or 4% of the whole population, which is really very small. So these are the kind of things we need to be careful about. When we see a big fall, that's the time we need to be ready to buy. And when we see something in extremely euphoric state, then sometimes we just need to be away from that. But here, what we've seen, majority of people do exactly the opposite. So what are the behavioral aspects during a rising market? When the markets are rising, news flow is generally good. Everyone is extremely euphoric, everyone is always talking good things about the market, like he said. Everyone talking only about how much money they have made in the market. No one will talk about how much they lost. So, and the availability bias at that time is strong. Everything is extremely strong, everything is very positive. So a lot of people think that they missed the bus, oh, everyone's making money, I have not made money, chalo, let me enter the market now. And this is a time when people enter at all the wrong time. This is a time of the peak of the bull market, and this is what happens when people enter at the higher levels. Also at the same time, confirmation bias. This is also we spoke about last time. Confirmation bias is like we close ourselves to negative news. So we only want to hear what's positive. We don't want to hear anything what is realistic or anything. So we just put that aside and we keep doing our investment because we think the herd is doing it, everyone is doing it, so let me do it. And in the end, everyone is just chasing returns. You need to chase value, and values are only got in the market when the prices are low. When the markets are subdued, that's the time you get the value, and that's the only time you make the returns. Here, everyone's waiting for a quick buck without even having a strategy or anything in place, just working on tips, which I think shouldn't be done at this time. So this is typically the investment pattern during a bull phase. Most of the money comes at the height of the bull market. When we are here, if you ask me my opinion, I think right now we are just in the beginning of the bull market. So we've not seen too much money also entering right now, and once the euphoria starts, once the extreme news and availability bias becomes really strong, we'll see a lot more money coming in, and at the peak, most of the people will start entering again. And this we've seen in history. This is not like a one-off kind of thing. It always repeats itself. For us, it is very important here that we don't make those same mistakes that other people make. We need to benefit from. We need to learn from that. And typically in a bear phase, this is what happens. Most of the money is up there when the market is actually coming down, and when the market is down, a lot of people actually don't have the money to, they are already stuck in some stocks and they don't have money to invest, or they just don't feel like investing because they are extremely fearful. So this is what happens. So there are two types of risk. One is perceived risk and the other is the actual risk. For example, in this picture, the actual risk is actually very little, but the perceived risk is more. But obviously this is a circus and that lion is trained, and there's not much risk to the person, he's not going to die or something. So here we think the perceived risk is we think the perceived risk is a lot, but the actual risk is actually very, very little. So this is the two things we need to keep in mind: perceived risk and actual risk. In 2009, there were a lot of these opportunities. There was like, I've just taken one of them right now here, but there are tons of these that were there. The stock price was at about 98 rupees of Patni Computers. The cash per share was at 150 rupees, and the book value was 222. No one wanted to pick up the stock even at that time because, again, as you can see, the actual risk in the stock is nothing. It's a no-brainer if you look at it in that way. And Patni Computers is good stock, good company. But the perceived risk during 2009 was so much because of global factors or because of whatever was going around. There was so much fear in the market that the perceived risk was so much and the actual risk was none. And people didn't do anything about it. And these were the times where you could get such opportunities and you could have taken advantage of such opportunities. So, in a rising market, the actual risk is much more than the perceived risk because of the high valuations. Here again, those 5 events that we're seeing, so we are taking 2 of these years, the tech boom and the market peak. This was a time when most of the money came into the market, like we saw on the previous slide. This is the previous slide that so much money came in the market during these times. Look at the returns that have been got during the tech boom right now. If your Sensex was 5,205 that time, and you would have just made about beating inflation after 14 years. After 5 years, you probably won't even beat the savings rate of a bank, you know. And this is the market you're taking. During the tech boom, most of the people invested in tech stocks, like we spoke about some of the stocks here. So if you're invested in those tech stocks at those prices, I'm sure today you're still in the negative. Similarly, going to December 31st, 07 with the market peak, most of the about 4,000 crores was pumped in at around that time, you know. Even today, you're pretty much flat. You're not even making 2% returns after so many years. And again, during that time, most of the people would have invested in infrastructure stocks, power stocks, real estate stocks, which is even going to be poorer than this. I think it will probably be still 30 or 40% down. So these are the things you need to do. In the rising market, the actual risk is much more than the perceived risk. So that's the thing you need to keep in mind. In a falling market, the reverse happens. Valuations are low, actual risk is very less. But the perceived risk is high because of some global factors or because there's so much fear spread in the market that you think that there's actually some risk in the market, but these are the times you need to invest in the market. Here we see all the returns again. Lehman Brothers collapse, after 6-7 years, you're making still a good about 18.5-19% compounded returns. In 04 BJP election defeat, if you're invested there, you're still making 17.5% compounded returns. World Trade Collapse after the Twin Towers and after the Afghanistan war, and during that time, if you're invested, you're still making about 18% year on year. And these are all compounded returns. So it's actually exponentially, you would have made a lot of money if you had invested in such times. So we need to again keep in mind rising market, be aware of your perceived risk and the actual risk, and falling market again do the same, and invest during falling markets. We have a saying in the markets: bulls make money, bears make money, pigs get slaughtered. So pigs are, for people who don't know who pigs are the guys who try to catch the bottom or try to catch the high, you know. They try to always time the markets. And I'll give you an example of someone I know where this has taken place. So on 11th of May, Axis Bank was trading at about 1472. Then we had a string of bad news for the banking sector. You know, we had the NPA levels increasing, we had the rupee depreciating quite sharply. We had like couple of black money laundering scams in the banking industry. The current account deficit was also widening, and banking sector was taking a bit of a hit, you know. So this stock started coming down. So this my friend, he asked me, should I buy? He asked me at about when it was 1100 bucks or something. Should I buy? I'm like, because he knew we were buying it in our fund and we had this and we've been holding it for a while. So he asked me. So I'm like, of course, it's fallen down pretty sharply. We like it. The valuations are good. Fundamentals are fine with the company. Buy. He's like, okay, let me see. I'll wait a little bit more. When it comes down, I'll see. I'll buy it and all that. A month later, it becomes 832. I'm like, boss, you need to buy it now. You know, it's a good price. You know, I mean, if you're bullish about the stock, let's buy it now. You know, I mean, you buy it and you keep and hold it, and you'll make good money. He's like, no, this will come down. This will come down. You don't know anything. You told me this before, but it came down, so I'll still wait for it. 764 it reaches. He's like, yeah, I'll buy it at 700 now. You know, 764. Then in the next 1 week, it goes up to 1024. I'm like, now at least buy it. He's like, no, I've seen the price of 764. So he was anchored to that price of 764. When the price was at 981, he was very overconfident. That time his overconfident bias was working against him. He thought that he was smarter than the markets and he knows how to price the stock. So at 1024, he's like, no, I'll wait for it to come to 800. So I'm like, what happens to 700 levels? So he couldn't buy it at that price. The stock kept going up, and till today he has not bought the stock. So if he was a bear at that point at 1472 or 1298, he would have shorted Axis Bank and he would have reported at lower levels. So he would have made money if he was a bear. If he was a bull at 998 or any of those levels or any of the prices below that, he would have bought it and he would have been holding on to it. Today it's at 1500 and he would have made money. But as a pig, because he was a pig, he couldn't participate in this whole thing and he got lost in the market. So it's actually futile to try to catch the bottom or catch the top. You know, so if we have to purely go on valuation, the valuations are good. If the valuations are convincing, then buy it, you know, whatever at that valuation. So you need to decide what you want. If you want long-term wealth creation, obviously the market is the right way to go, and obviously there you need to be in the right businesses for the long term. If you want excitement, then tomorrow a great thing starts called the IPL. You all can get it from there. So the choices, I mean, people want different things, but for long-term wealth creation, we think that market provides a really good opportunity. Also, let's not take market review from people like CNBC, some market expert or someone you don't know, you know, who just works on tips or something. We need to have at least a good strategy in place or a good process in place for that matter. Do not chase fancies. We've been talking about this. I mean, people who've been here who've been attending FOF for years. Every other presentation is like, do not chase fancies, because you know what happens. You get fancy losses. That's what's happened here. IT funds in 2000. I don't think most of people are making money on that. Still, after 14-15 years, they're pretty much stuck. Reality funds in 2007, still down, not making money. Gold fund in 2012, where the euphoria of gold was there, still gold is coming, it's a bit down today. And that was again, we thought that was a bubble and we shouldn't have invested in gold at those levels. Follow value. Anyway, Bombay Road, we can't drive a Ferrari, so this is good enough for right now. So what we need to do, we need to have a proper asset allocation in place and we need to diversify. By diversification, we don't mean spreading ourselves too thin or putting all our eggs in one basket. Today we see a lot of these mutual funds in their scheme. They have about 200 stocks or 150, 200 stocks. That's spreading yourself too thin, you know. I mean, how are you going to make money? Even if one of your stock doubles in price, it's not going to affect your NAV at all. So they're just spreading themselves too thin. Other don't put your eggs all in one basket. So an example of this was about 2 years back. We had one of our clients, and he had invested with us for quite some time, 5-6 years. His CAGR was about 16-17%. But fair enough, obviously after 2007-8, for a year and a half, the performance hadn't been that good. It was pretty flat. So he had a big portfolio of him, his wife, his daughters, everyone. He liquidated all that, and he said that, and he was telling me at that point that he put all his money in this real estate company who was offering him some 24% for lending. Those were the things that were available at that point, you know. So he took all his money out of the market, put it in this scheme or whatever of this real estate company where they were promising him 24% to 26%. He's an old enough guy, you know. I mean, he didn't need to take that kind of a risk, because I met him 6-8 months down the line, and he actually lost some weight. He's like, boss, these people are not even paid me a little bit, you know. we would have been better off just being with you, or at least I would have diversified and been better. So we need to be careful about these mistakes, that don't put our eggs in one basket and don't spread ourselves too thin also. Asset allocation has to be done depending on your risk capacity of an individual. It depends what you need, but you need to diversify across assets and within assets. Every asset provides you some quality. So we have, I've just taken equity, real estate, gold, FD. Some of the parameters that you would want to invest would be liquidity, post-tax return, and volatility. All these assets gives you different permutation and combination of what you need to have. Some are good. Liquidity, equity is the best in liquidity, but also at the time it's the most volatile also. But post-tax return, that in real estate has pretty much given the maximum post-tax return. FD, if you don't want to take any risk, then obviously put it into FD, and your returns will be less than inflation. Liquidity is not there, you'll be locked in. So, like I said, everything gives you, all these assets gives you different parameters of what you want to invest, how you need to invest in. So, asset allocation, you need to have proper asset allocation depending on the risk profile of the person. It depends on you, what type of risk you want to take. If you don't take any risk, then obviously put it in FD and all. But if you're willing to take, if you have the patience and you have the temperament to see some volatility, then definitely equity is the right way to go. And here I also want to talk about how, because of this principle of asset allocation, is how our whole mutual fund, PPFAS, long-term value fund came into. That's how we designed it. We started with this asset allocation approach. We wanted to be a one-stop shop for everyone. If someone wants an equity allocation, they need to come to us and they can invest with us, because we wanted a fund where it would invest across geographies, across sectors, across market caps. A lot of the clients came to us and with like 8 or 10 mutual fund schemes of the same fund house, large cap, small cap, mid cap, and we would be like, why would you want to confuse investors so much? Why would you want them to do so much more paperwork and take care of it? We decided let's have something where we can do all these things. Hence the scheme we designed it as a scheme that if tomorrow someone wants an equity allocation, they will just have to put it into one scheme and we will do their whole equity allocation. If it's across sectors, across market caps, across sectors. So the principle of asset allocation is what helped us design this scheme. And also assets should be in proportion and not go overweight or underweight due to extreme optimism or pessimism. So if tomorrow if the stock market even goes down, if you have an asset allocation of some whatever 60-70% in equity, and the market goes down, doesn't mean that you change your asset allocation because of the vagaries of the market going up and down. So you need to be very equanimous when you come to asset allocating your resources. So these two guys are pretty much saying the same thing, different personalities for sure. So डर गया समझो मर गया. So it's like he's saying that don't panic when market goes down. You make money in the markets because of this, not because of the absence of risk. And obviously we've spoken about this and we've proved it in the previous slide that we need to be fearful when others are greedy and greedy when others are fearful. And sometimes the best action is inaction. When the markets. I remember this was in 2007 in our own firm. We were. It was 2007 and everything was going up and we were like, okay, this is really overboard. Reliance Power, IPOs and all came. We were like, okay, we don't understand this. So I remember there were days in our office where we would have the match on and we would be just watching it because we didn't have anything to do, and that's the best thing sometimes to do is like don't do anything. And that takes the most guts to not do anything, So sometimes you just need to sit back and relax and wait for the right opportunities to come your way instead of just trying to do something and trying to justify that you're doing something, So long-term investing does not guarantee return unless you invest in the right business at the right price. So you are not saying that, okay, put into any stock or put it at any time and let it just, you wait for 5-7 years and you're guaranteed to make money. No, you need to put in the right businesses at the right time. Very, very important. If you don't have the time or the inclination or the expertise, there are some great mutual funds available. You can invest through mutual funds. buy damaged stocks, not damaged companies. Sometimes we see that bad things happen to good companies, the good businesses. They are like, the business is doing well, they are paying regular dividends, the net profit going up, all the parameters are there for it being a good business, and you want to hold it. But sometimes the situation is such, or the environment is such that the stock price is coming down, and those are the times that you need to probably buy those even more, if it's fundamentally strong. Now there are also other businesses. For example, Kingfisher Airlines in 2007 was trading at 300 rupees. Today it's at 3 rupees. That's a damaged company, not a damaged stock. I mean, you wouldn't want to buy a Kingfisher even if it's 3 rupees. Even when you are seeing 300 rupees and today it's 3 rupees, you probably won't buy it. Because you can still use 100% of your wealth in it if it becomes zero, which is good chances of it actually going down to zero. So you need to be careful about what type of businesses you get into. Just because the price is low, whatever you see at the price, you need to see the value of the valuations of it, not the price of it. And you need to care of the equity and debt market unless you have a temporary volatility. Volatility is always going to be there, and volatility is our friend, and that's how we make money, is because of this volatility. It gives us opportunities to buy, and it also gives us opportunities to sell. So be a friend of volatility. It helps us in the long run. Okay, whether a decision to invest in equity was correct. Again, I've taken this from since the market has started, and 1st April 79 it was at 100, the index Sensex level. And we see that over the long term, it has produced good CAGR returns, 16-17%. This again, I'm just taking Sensex, and this is not an actively managed portfolio, which you can expect even higher returns out of that. But now if you are invested in 1994, this is right after this is during time of the Harshad Mehta scam and all that stuff, when the markets were again at a peak. If you're invested there, you're still pretty much just about at inflation levels. After 94, so that's 18 years or something, you're still not making that much money. 2007, again, if you're invested at the peak of those at those markets, you're around 8% even after 7 more years, So you need to invest in the right businesses, and you need to invest when valuations are low. When others are greedy, that time you need to be careful. So equities outperform other asset classes over the long term, and why is this correct? Is because number one, like you said, that after 1 year, equities are tax-free. There's tax-free returns you can get here. Liquidity is very, very liquid. I mean, you can sell your stocks today, you get your money in a day or two. So liquidity really is a key component to this. Low investment threshold. I mean, today you can invest through a mutual fund for 1,000 rupees also. That's the minimum value. It's like, for example, if you want, not everyone can buy a property or real estate, because the investment threshold is high. It's not very liquid. If you really need the money, you can't just sell your property and expect to get it in the next 2 or 3 days or a week time. And global equity diversification. Today, sitting in India, we can invest in any market. I mean, that is the beauty of it. Today, we get opportunities abroad, which we don't get opportunities in India. There's like companies like Google and IBM and stuff like that. These tech companies that are not prevalent here. They're more back-end companies here. So we can diversify into those businesses which we don't get an opportunity to invest in Indian businesses, in Indian companies. And very few or no asset classes come close to equity on the above parameters. So if you want long-term wealth generation, I think equity is the way to go. And yeah, that's it. Thank you. Yes.
Those returns were dividend adjusted?
Yeah.
So where should we sell? It is like you see, systematic invest. Yes, you should exit also systematically.
It depends, yeah. I mean, systematically. I mean, if you require the money, then yeah, systematically or whenever you need it. Otherwise,
returns will be good if you exit systematically, or it will be good if you exit one time.
Yeah, I mean, if you exit at a high level, for example, in 2007 or something, when the valuations are very expensive, and when, like I said, when the availability bias is so strong that everyone, your Panwala or anyone is talking about stock markets, or you are hearing everyone is making money in the markets who usually wouldn't enter, and just tips and all are there. There are these indicators you get that, okay, this is the time I need to get out of the market and stay a little away from it. So So we in 2007 there was clear cut kind of these thing when Reliance Power IPO came out, when everyone wanted to buy. I mean, it was just madness, you know. When you see such things, then you probably know that it's better to get out at that time, you know, get at least most of it out. And whatever the good companies are there or the valuations are there, and you obviously see the valuations. If the valuations are very stretched, then obviously you sell the company, you sell the stock at that time.
Is it that time to get out of this?
No, I think it's the time to get into it.
Today,
It is my personal opinion. So.
but it's very high.
It's relative. If you see it on a PE basis, it's less than, it's around 15 times earning. It is less than the 10-year average of forward-looking PE. So it's actually pretty cheap. If you ask me.
15 times as trading PE
Forward PE.
But don't you think, I mean, coming back to the valuation, don't you think a lot of the higher quality companies are already pretty decently valued?
Yeah, no. So I'm not saying the whole market, buy the whole market and all that. Obviously, there are pockets which will be very overvalued. Like for example, FMCG and all are still pretty expensive. You won't get into FMCG right now. We'll still wait for it to fall. I mean, further because it's had its good run, you know. So obviously, if you look at it, there are pockets of sectors or companies which are still very undervalued, and those are the ones you need to get. And valuations are there. Some companies are definitely still quite expensive, and you won't get into them. So, as a whole, I mean, yes, you need to look at it.
Sure. But just following up on that question, you know, there are companies which you want to hold for, as you said, long term, 3 to 10 years. You know, there are easily businesses which you want to hold for 5-7 years. But they are far ahead of their historical valuations, 30-40% higher than what you would give to them as an intrinsic value. Right. Do you suggest that those points kind of, but you might have your intrinsic value wrong, and therefore lose out if you sell that company and it still kinds of compounds not in the market. So what do you think one should do in such a situation?
So, like you said, like some of them are like really good companies. For example, like say Google also right now is pretty valuation wise pretty high. But if you ask me, I will keep holding on Google because I don't see there's another. I mean, when I use Google Chrome or Google every day, I know my life is actually empty without it. If there's no Google, I don't know how I live my life. So when I see such things, I'm like, okay, I know for the 20 years. 30 years or for the foreseeable future, Google is going to do well. So for that, I will keep a Google. Even if it's expensive, yes, it will go down, but it will make a higher base. Every time it goes up, it will go down and make a higher base and go up. So I think you see it as you value it as so beauty is in the eye of the beholder, right? I mean, so
give an example of damaged company, damaged stock.
Yeah, so damaged.
So the damaged company was
Kingfisher.
Any example of damaged?
Damaged stock? ILFS, investment managers. That was the damage. I mean, dividends were up, net profits were going up, but stock prices were going down because the general environment for PE and all that was not in place. You know, so that's damage.
What index fund?
Index fund we don't actually like. We've actually we had in his second book there is actually a very interesting study on index investments. What we did was from the start of the Sensex or the Nifty, whenever it started, how many stocks went into the Nifty or the Sensex and how many stocks came out of the Nifty. What we did was we did an experiment that we will invest 100 rupees or whatever worth 1000 rupees in the one that has gone in and also 1000 rupees for one that has got out. What we saw that the one that got out outperformed the one that went in by a factor of I don't know how many. Like it was a huge difference. I don't know the number on top. I don't know if you know the number.
It was double.
It was double at least.
The portfolio of the laggard companies, that's the one which were thrown out. They are saying the portfolio of 3,20,000 of the BSE Sensex was valued at somewhere around 96 lakhs. And newcomers, the 3,20,000 portfolio was valued at about 48 lakhs. So
you're talking about Google, but let's, especially the tech business, the dynamic businesses, the life cycle is so short. 3 years back, no one could have imagined BlackBerry would be close to going bust 3 years down the line. Ultimate stars have come and gone, and all. It's very, very dynamic. Certain businesses, you just don't know what kind of life cycle they may have. How does one identify that?
I mean, what happens in the future, obviously we can't predict. I mean, we obviously can't even predict who's going to win the election, which is again a month down. 4 years from now, if a company shuts down because of certain reasons, is something very hard to predict. What we can do is, at this moment, will we buy this stock? At this moment, do we think there's value in this company? I mean, yes, there have been times when, okay, I mean, people who invested in which tech company that went bust recently? Satyam. For example, Satyam.
That had a different issue. I mean,
Yeah. So I mean, exactly. So what you're saying is that anything can happen. Like for 3 or 4 years, no one expected Satyam to go bust. 3 years before that, it was a Sensex stock, Nifty stock, was a favorite of the market. You probably couldn't at that point think that something like this would happen and it would go bust. So yeah, I mean, sometimes unfortunately some bad things might happen, which is very hard to predict or even fathom at that point of time.
Something like Kodak.
Technology changes. Yeah, so that is something that's part and parcel of the game, and I guess you just need to take that in stride and move on. But Xerox also same.
Is there any way of valuing a mutual fund? Just like you said, the share is overvalued or undervalued.
I mean, I can talk about our fund. I mean, you probably think it's overvalued when we have a lot of money in cash, or when we're doing a lot of cash to futures arbitrage, where we know that okay, we think the valuations are expensive. That's probably a signal that yeah, I mean, we are pretty much fine right now with the valuation. We probably won't want to invest more money in direct equities right now.
No, that is without India fund.
Yeah.
But for an outsider, how does he know that the fund is?
There is research report as well.
Sorry.
There are some research reports are available.
Yeah, I mean, the research, modern research reports is how, I mean, I can say how we can value our fund. I mean, like a lot of the other funds you actually can't, because I was also holding a few.
I have just written a blog today.
Okay.
It will be out in Economic Times tomorrow. It is exactly how do you choose a mutual fund. My blog should be out by tomorrow day.
So I guess we'll know it tomorrow.
You should read that.
We can preview. I just
Yeah, sure.
How do you value a mutual fund? It's a very important thing. Now, the dilemma which we faced with our own fund was, today what is happening in the market? When you are investing in a mutual fund, what are you doing is, you are putting your money, your resources into a mutual fund. Then you have managers who are managing. Now the problem arises because the manager's remuneration are linked to the assets under management. Actually, the manager manages the money of the mutual fund. The investors put money in the mutual fund, and the remuneration of the manager is directly linked to the assets under management. So what is happening in today's mutual fund industry is, everyone is in the race for assets under management. Actually, the mutual fund business is about stewardship. That if I have a mutual fund, they say, I am the trustee of you as investors in my mutual fund. This stewardship. I have to perform for you. But because of this race for assets under management, stewardship has taken a back seat and marketing has. That's why you have today multiple schemes. This is one part. Second part, and the most funniest part is that about a mutual fund, no tracking companies like Value Research or Cafe Mutual or Morningstar will talk about a new fund. That's why Ashwin's question is very pertinent. That how does he know which mutual fund? Because they only talk about mutual funds having a 3-year track record. Now, every mutual fund writes, past performance is no guarantee for future performance. In spite of that, all these tracking companies, they ask for a 3-year track record. Now that's an irrationality which is existing over there. The present day mutual funds, they are marketing organizations. Now this is what we learned from experience with all these mutual funds that last year when we set up our mutual fund, we decided that what is important is how a scheme is structured. For us, our fund manager should be able to take every opportunity which is there existing in the market for investing. So we took 6 months to devise the scheme, and that scheme allows our fund manager Rajiv to do anything in the market. How did we learn this? On the other side, if you have a real estate fund, he invested only into real estate companies. If you have an infrastructure fund, they only invest into infrastructure companies. If you have a small cap fund, it is only for the small cap. Similarly, mid cap, large cap. So, because of this marketing gimmick, they have actually curtailed the investment horizon of their own fund managers. Now, this is what we learned, and that's why we devised our scheme in such a way that we are able to tell boldly that this is the only scheme we'll come up with. Because if our fund manager in one scheme can take care of everything, what's the point? Then you don't require multiple schemes. Secondly, as a mutual fund, you have to have one greed out of your mind, not going for assets under management. Because when you are looking at stewardship, your idea is to how do you perform. That was the basis on what we formed the mutual fund. That is most important. Secondly, people behind it. Today, in a mutual fund, we've got 1 year track record. But in managing money, I've got a 30-year track record. Rajiv has got a 18-year track record. Similarly, Ashish and all, they have about 15-20 years of track record. So, the firm could be, the people behind it could be having a big track record. But the mutual fund has only 1 year track record. That's why such funds will never be identified by the market. That is the reason. That will give you an idea. Thank you. Okay, thank you. But I just want one suggestion to all of you. We are all value investors. So, as it is, the sunk cost has already taken place. We have already spent for the dinner. So I would appreciate that everyone do justice to the dinner and go otherwise. As value investors, we have to, they say you cannot allow anything to go waste. Thank you. No, she is sitting now. She is sitting.